commercial real estate took something of a hit as the interest rates came up. Did you see transactions go down a lot, and are you seeing them come back up, just in the number and size of the transactions?
Yeah, we've absolutely seen transactions come down. What we've seen is that really there's a capital markets freeze right now. Lenders, banks, mortgage providers are staying on the sidelines right now. They're in a lot of ways licking their wounds as they focus their attention on the most stressed assets in their portfolio. And so we absolutely are in a bit of a freeze with the comments yesterday from the Fed. The outlook, frankly, is one where it does seem like we're going to continue to see a slow trickle of stress and distress. But at the other end of this, there will absolutely be buying opportunities, especially in the middle market, the mid-cap space, where there's a lot of regional banks that we've been partners with and interacting with.
Well, Ryan, that's what I'm curious about. When you talk about this freeze, I'm wondering, when it relates to commercial real estate, is there any one sector that has been particularly frozen compared to the others, and where you think those buying opportunities will really appear?
Yeah, absolutely. What we've seen is that office at large is really the sector that's been the most affected and impacted. The reality is that even with a lot of return to work policies and more demand, there's still a ton of volatility in terms of how long tenants are staying in space. And as a result, there's less cash flow, and banks are very aware of that. I think there's a fundamental shift in the paradigm of what working even entails in terms of being together, in terms of engaging with others and the like. And so what we're seeing is that there's for sure a lot of stress in the office space. The question is, where's the opportunity? Our view is there's a tremendous opportunity in conversions, converting office to residential. Now, that means that you're going to have better zoning mandates in place. You're going to need more public-private partnerships. But that's the kind of silver lining to the stress that we're seeing, is that there absolutely will be more housing, because we need more housing as a country. And for those landlords and owners that are able to negotiate with their banks to buy more time to extend and have an on-ramp or an off-ramp to residential exits, that's where we think there will be the most opportunity in that space, in that asset class. At large, every other sector we've seen has been impacted, from hotels to apartment buildings to industrial warehouses, but no one has seen nearly the effect of the capital markets dislocations and the macro environment as office owners have.
Ryan, I'm really glad you raised residential, because one of the questions that we have is whether those increased interest rates actually help a bit when it's multifamily rental units, because we can't afford to buy. We talked actually with Kathy Marcus of PGIM Real Estate Investors yesterday. This is part of what she had to say on that subject.
There's a lot of growth in the population cohort that tends to rent single-family dwellings. And single-family dwellings, from an ownership perspective, are less and less attainable by people because of a lot of trends that we've talked about. This longer, higher for longer interest rate environment, the fact that there's not a lot of supply of new homes, all of that leads to less and less people being able to afford to actually buy a single-family home, and therefore they're going to rent one.
So, Ryan, is that what you're seeing from your point of view?
Yes, for sure. We're seeing that right now. But I think what's important to recognize is, everyone's talking about capital markets and the interest rate environment being the largest catalyst to the current divide between those who are buying and those who are renting. And we absolutely seen that spreads between the cost to rent and the cost to own are as large as they've ever been. But there are some drivers of demand and change that we think are going to play out that investors should be focused on. One is, we will absolutely see a massive wealth transfer amongst millennials and those even younger over the next 5, 6, 7 years. What's going to happen there? Cash, on people's personal balance sheets will increase significantly, and we believe that there will be an uptick in demand as a result of this increase in personal liquidity and net worth. It'll be the biggest wealth transfer in our lifetimes. The other important nuance that I think actually gives us a bit of hope and optimism that there will be more activity in residential real estate is we're seeing more and more local government, cities, municipalities focus on providing incentives, first-time home buyer credits for those looking to jump into the residential real estate space. We're also seeing, obviously, more zoning. You see it here in New York City, conversions and more intent and will from local government and politicians that I think is absolutely paramount if we want to see increased activity. So while I agree that the cost and the spread is significant. And yes, a lot of people are on the sidelines. I think it's also important to recognize that there are a lot of people who also want the empowerment and the American dream to be fulfilled, and recognize that real estate is still the most important asset class to build long-term multi-generational wealth, and will be leaning in and adapting to the new normal and the new environment that we're all in.
Well, following up on that point, that when it comes to state and local governments, there's some that are introducing incentives and are really focusing on their housing markets. When it comes to geographies, regions of the U.S., where are you finding the most opportunity?
Yeah, where we invest primarily is in multifamily and industrial middle market or mid-cap assets. So these are properties that are typically between 15 and 50 million of equity that we're acquiring. We just launched a new fund, Cadre Direct Access Fund 2, which is basically an opportunistic value fund that will build a portfolio of these assets, and primarily in the Sun Belt. What we're seeing is that there are a lot of local owners and operators who have loans with regional banks, and many of the regional banks, actually just spoke with more than 100 CEOs of regional banks recently. They're all incredibly worried about this current macro environment. And what's happening as a result is they're paralyzed. And so you're not seeing refinancings, you're not seeing new credit being issued. And as a result, the owners of assets, even in some of these more affordable, high-growth, Sunbelt-oriented markets, they're looking for exit valves and looking for rescue capital. And so what we've done is really focused on the Atlantas, the Dallas, Texas, the Phoenix, Arizonas, again, high affordability, high growth markets around the country, and look for these best-in-class local operators who maybe have stress in other parts of their portfolio and are looking for liquidity to kind of stabilize their holdings. And the beauty of real estate is it's a pretty large macro environment, and there's always micro opportunities. So we like Sunbelt-oriented multifamily and industrial assets with top-tier local operators and developers who may have some stress, may have some capital markets dislocations in other parts of their portfolio. And as a result, we are starting to see opportunities trickle in that we think will be the most attractive over the last 15 years based off of pricing.